Good afternoon, guys. A very warm good afternoon to every one of you. So we'll wait for a few minutes so that others can join as well, and then we'll start. Why timing changed? Because every one of you requested in the last class that you are facing it really difficult to attend late night classes. That's why I requested the management to change the timings. And this was since the only slot available. That's why the timing changed to 4 to 6. Ritik, not too early, not too late. Even I can't force them to change the timings again and again, right? Some of you are saying that this timing, some of you are working on this time on their weekends, on Saturdays especially. So, what is happening, guys? This is creating a trouble between the one who are professionals and one those who are not able. So we have students from tier 2, tier 3 cities with who are not able to extend their lectures to 9:30 to 11:30 because most of the crowd over there sleeps by 9:30 or 10 o'clock. So although changing timings is not in my hand, so they, all those guys were requesting me to change the timings from 9:30 to 11:30. Uh, so since many of you requested this, I escalated the issue to the management, and but they have strictly told me that they won't be able to change the time again and again because the slots should also be available. There should be slot available, and yes, we can't have timings from 7 to 9. We are working on Zoom. Zoom should give us that slot as well because there are other classes going on for with data trained like uh, Power BI or other subject classes like data science and all. So we won't be able to change timings again and again. So bear with this timing for a few days at least, and then we'll think about it. Even I can't help you guys anymore now in at least for the next few days because I have requested them multiple times and they agreed to change the timings. No, it won't affect much, Shatrughan. It won't affect much. So shall we start with the class? Does anyone need the model? I am sending the first model that we made in the last class and the relative valuation model that we will be continuing for today. Okay. Yes, K, please let me know on LMS after 28th July. It will be uploaded. The backend team is working on it. There is some issues with the timing, sir. I want to highlight that there any response on tickets raised the data train team. Which tickets have you raised, GA? I'm really sorry, but any such tickets related to me or the course? Uh, or tickets with respect to which department so that I can highlight that department and help you out. So K for that, For that, we will have to work together on the ticket. If you might have raised any tickets in the last 2 days, that is Friday or Thursday. So I had week offs on Thursday and Friday, related doubts like assessment, pre-placement process, and mock interviews. So let me see, GA. Let me check up with the backend team, and I'll let you know by tomorrow in the class itself. Excel sheet is being uploaded in the chat box. If you are able to see the Excel sheet, Kay, have you joined through your mobile phone? Probably that's why you might be not able to see the Excel sheet, but Excel sheet have been uploaded in the chat box. Okay. Now we have this data available with us. Everyone has this data available with you guys. Do you have this data available with you? Perfect. All these ratios are in multiples except dividend yield. So I will be formatting these ratios, selecting the whole ratios. I have uploaded the sheet. The sheet will be uploaded on LMS as well. The sheet will be uploaded on LMS as well. So today itself, I will personally make sure that the sheet gets uploaded on LMS as well after completing this whole model. Now, number custom, I will change this from percentage to 0.00, and in bracket, I will mention times 0.00 times. Click on OK. And yeah, all these ratios are represented in times format. Okay. Now, anyone remember the formula for enterprise value from the DCF class? Anyone remember the formula for enterprise value from the DCF class? What was the formula for enterprise value that we discussed during the DCF class? Please do reply, guys. Market value of equity, very good, plus debt minus cash. Now, now just give me a second and let me connect my pen tab so that I can explain you something. SK, we have not started anything yet. We have just given a custom format to this multiple times, the multiple format. Just give me a second so that I can connect my pen tab, and then we can have a discussion, a short discussion on quartiles. How many of you are aware about the concept of percentiles? How many of you are aware about the concept of percentiles? If you might have given any competitive exams like JEE, NEET, or CFAs, or any such exams, you might have got your scores in percentile format, if you remember. Okay, so what is percentile? How would you define a percentile? What would it mean if I say the score is in the 99 percentile or 98th percentile? Now, there is something called as 100 percentile, 75 percentile, 50th percentile, 25th percentile, and finally the last percentile, 0%. Now, from 1 to 100, all these things, all the observations are divided in four parts. Part 1, part 2, part 3, and part 4. These four parts, when I divide a percentile into four parts, I would get a quartile. Quartile is nothing but a quarter of the whole. Okay. So these are quartiles. We are going to implement the same logic, same logic. Now, what do we mean by quartiles? Let's suppose if you have scored if you have scored 100 percentile, it means that if you have performed in the 100 percentile, it would mean that 100% of the students are behind you, It means that you have scored the highest marks, and every other applicant has scored less marks as compared to you. Sometimes 4 or 5 people come in the 100 percentile bracket, or 6 or 7 people come in 100 percentile bracket, because there are a lot of test takers. Because in case when there are lots of test takers. Now, what would it mean if you are in 75th percentile? If you are in 75th percentile, if your percentile score is 75, it would mean you have left behind 75% of the students. You have left behind 75% of the students, but you are standing behind the next 25% of the students. So all these students are above you, and all these students are below you. All these students are below you. Okay, so this is percentile. So when I talked about quartile, when we divide the whole percentage thing into different parts, we get quartile. Okay. Now we are going to implement this in our analysis. How? We are going to evaluate the quartile variations, the quartile observations of all of these ratios: price to earning ratio, price to revenue ratio, price to book value ratio. We are going to calculate quartile observations of these. Okay. So let's start. Let's start with our comparable company analysis. Let's give a bit. Yeah, we will be coming to formula. We will be coming to the implementation of the formula. Let's just take care of the formatting part first. Okay. comparable company analysis. Seventy-fifth percentile. We will also calculate average, that is mean value. We will be going for median, that is nothing but 50th percentile. Then 25th percentile. And then the lowest value. Just give me a second. Let me check one thing. Okay. Okay, you want me to explain percentile again? Yes, I'll be explaining percentile again. Just give me a second. 100 percentile lowest value. Okay, fine. Then we need median. Fair enough. So percent, remember median. RM, what is median? What is median? We explained about median in the last class, and why we use median, we also did explain that. RM, guys, did we cover why we are using median instead of mean? And did we made a concluding statement on it? So tell me, let's do that exercise again. Mean is segment of not. So K is saying mean is segment of outliers. No, mean is subject to outliers. So keep changing, but median remains constant. Median does not remains constant. Median is less sensitive to outlier. So let's say these are the observations: 1, 2, 3, 4, 5, 6. If these are the observations available with us, and let's say 7. If these are the observation available with us, calculate mean for these observation and calculate median for these observation. Please be quick, guys. Do calculate mean and median for these observation. Median is 4. Very good. Median is 4 and mean is 4. Fair enough. Someone is getting mean 3.5. No, mean and median both would be 4. Now change this 7 to 17. Now what would be the mean? Mean would be 5.4 and median would still be 4 only. So when I am changing the last observation, my mean is getting changed, but my median remains same. When I am changing the last observation, my mean is getting changed, but my median remains same. So what is basically median? If you, if let's say these are the observation, control C. Okay. If these are the observation, and if I want to calculate the middle value of these observation, for that I will have to sort this data, based on column F, no, column G, cell value smallest to largest. Okay. The number of observations would be 1, 1 to 15. Now the middle value would be 7th and 8th. 7th, 8th one would be the middle value. So this is my median. Median is nothing but the middle value. Now middle value is not changing. You can see over here, this would be, if arranged in a chronological order, this would be the median value or the middle value. Over here as well, if I try to calculate the mean and the median is equals to mean, average is the function used for mean, number 1, and selected the whole range. This is the mean. What is the median? These values are my median. Now, if I change this 89 to 92, my mean is getting changed. 199, my mean is getting changed. 199999, my mean is getting changed, but my median is not getting changed. So median is less sensitive. Median is less sensitive to outlier. Now, what we are evaluating over here is, what we are evaluating over here is that how can we find that what are the companies, what are the values in the top percentile, that is top 25 percentile bracket, that is first quartile, next 25 percentile bracket, then in the next 25 percentile bracket. So this is the top percentile. This is 100% to 75%. So 100%, the top 100 to 75% of observations lies over here. It means that the companies with top 100 to 75 PE multiple, PB multiple, price to cash flows multiple will lie over in this range. Whereas if we try to calculate for the next 25 percentile, it will lie over in this range from 75 to 50. And this 50 would be my median value. This 50 would be my median value based on which we are going to do our valuation part. Then we will be going to 25 percentile and then 0 percentile. So this is my first quartile, second quartile, third quartile, fourth quartile. Basically, out of all the 400, all the 100 observations, all the 100% of observations, we are dividing that observations into 4 equal parts. Not equal, but 4 parts where we will be getting the top 25 performing price to earnings multiple or ratio multiple, the next 25% of good performing multiple, the people belonging in the last quartile and the second last quartile. So are you guys comfortable with what is quartile? Are you guys comfortable with this? What is quartile? Okay. Someone asked, RM asked, I guess, about the quartile. Yes, Radhika, are you comfortable with this? Actually not, it's not straight away divide by 4. We are represent. So let's suppose 100 of test takers appeared for the exam. 100 of test takers appeared for the exam, out of which out of which 4 people scored the highest marks, that is 100 on 100. So these 4 people have left behind the rest of the class. These 4 people have left behind the rest of the class. So these would be in 100 percentile bracket. Now let's suppose if you have got results that you have scored 75.6 percentile. It means that 75.6% of students are behind you. The 75% of students are behind you, and the rest 25% or around 24.4% of students are above you. Okay. So not the companies, but the multiples. Multiples in the top 25% of top 100. So the highest, this 75 percentile, this 100 percentile. If I say 100 percentile would be the one with the highest value. So we will be using maximum function over here from number 1 to the last number. This is the maximum function. Now 89 would be the highest value over here. That is why we would have got here 89. It means that the price earnings ratio of company, that is 89. We will also see that how we will base our valuation on how it is important to base our valuation on 100 percentile and 75 percentile, average, median, and mean. Now, this 89 says that the 89 percentile company, that is Hudson Agro, is priced at the highest multiple. It has left behind all the peers in the multiple, which would be a green flag for this company, which would be a red flag for this company. Why this would be a red flag? This would be a red flag because out of all the companies in the FMCG segment, this company, that is Hudson Agro, is priced at the most multiple, is highly overvalued, is priced at the highest multiple. So that this will make Hudson Agro the most overvalued company in the whole peer group. Are you understanding this? Are you understanding this, guys? This 89.07, out of all these companies, 89.07 being the value, being the multiple with the highest value, this will make the respective company of 89.07, that is Hudson Agro, most overvalued as compared to its peers. What I mean by this, let's say this is 100 percentile. This is 100 percentile. What would be the lowest percentile, that is minimum out of all these values? What is the lowest percentile bracket? That is 0. This is 20.19. 20.19. If price to earnings ratio is 20.19, it won't make any sense to us to include that company. It won't make any sense to us to include that company. So let's go for a company with the lowest ratio other than this to 20.19. So that would be minimum of, just give me a second, I'll explain this. Let me just make this and I'll explain this. This is the lowest value, 17.55. What is the meaning of price to earning ratio? One of the company has price to earning ratio as 89.07. One company has price to earning ratio of 17.55. One company has price to earning ratio which is highest in the peer group. The other company has the price to earning ratio which is lowest in the peer group. Guys, can you just give me a second? I'm getting a call from backend. I think there is an issue. Just give me a second. Anyone Katika from the class? Anyone named Katika from the class? Guys, anyone named Katika from the class? I just got a call from the team that Katika is informing the backend team that I am not replying to her messages. But I'm sorry, Katika, I am not receiving any of your messages in the chat box. I am not receiving any of the messages in the chat box. I'm really sorry if it got ignored in the pool of messages, but still I am not able to hear any of the messages from your end. Okay, so where was I? I was saying the highest value. This is the PE multiple with the highest value. Then we have a PE multiple with the lowest value, because many of the people were complaining, Rohit. That's why the timing changed to 4 to 6. Many of the students were requesting to change the time. That's why the timing has been changed. Okay, this was the highest value 89.07, and this was the lowest value 17.55. Now the question is, what does the value of this 89.07 mean? What does this value mean? This value mean that while earning 1 rupees, this company is priced at 89.07 times of its earnings. The company, whatever may be the company, what Hudson Agro, right? Hudson Agro. Hudson Agro is priced at 89.07 times of its earnings. Hudson Agro is priced 89.07 times of its earnings. It means that out of the peer group of all the companies, Hudson Agro over here is the most overpriced one. The Hudson Agro company over here is the most overpriced of all. Are you getting this? And this company that has the lowest price to earning ratio, this company that has a lowest price to earning ratio is 17.55 times. 17.55 times. What would that mean? So RS, you will still have to manage it for a few days, because many people were complaining it's not possible to change the timings again and again. Okay. 17.55 times. It means that if company is earning 1 rupees, company is priced 17.55 times of that 1 rupees. Company is priced 17.55 times. Based on the face value terms, based on considering only these two ratios, which ratio is a red flag for you, which ratio is a green flag for you? Considering the interpretation of price to earning ratio, which company would you want to invest in? MF is saying what factors determine this price to earning ratio. The formula for price to earning ratio is MPS upon EPS. What is the current market price and what is the earnings that the company make? These are the only two factors that determine PE ratio. This is what we covered in detail in the last class. So we will go with company with 0.17.55. So what this highest multiple says, if you feel that your company is best in the industry, you should compare it with the company. It would mean if your company is a market leader, if you feel that your company is a market leader, or the company that you are evaluating is a market leader, or has the most proportion of market share, let's say more than 60 to 70% of the market share, if captured by your company or the company that you are evaluating based on PE, your company is the best company in the market. If you feel that your company is the best company in the market, you should compare it with company in the top percentile. You should compare it with the company in the top percentile. Based on this, you should derive the value of your company, because the multiple at which Hudson Agro is priced should belong to Dabur. If I feel so, then I will base my multiple. Then I will base my multiple of Dabur based on the price multiple that Hudson Agro is getting. Now, this is not generally a good idea. Why? Because 89.07 is the multiple for Hudson Agro. Now, Hudson Agro, when we talk about Hudson Agro, it is the most overvalued firm in the market. It has it has highest price to earning ratio. It means that in simple terms, if I want to explain you, this company Hudson Agro is the most costliest shopkeeper in the market. This company is the most costliest shopkeeper in the market, or this company is selling its product at the most. So this would be inappropriate. Selling its product, I mean by shares. This company is priced at the highest multiple. This is a red flag for the company, because this is priced at a higher multiple compared to its peers, and it can be expected that when things might cool down for them, this company might see a major correction. But did we uh, make this conclusion based on the just price to earning ratio? Didn't we discuss that we need to analyze each and every ratio, and based on this, that we can make a conclusion? We cannot make a conclusion based on one single ratio, but based on price to earnings, Hudson Agro is performing best and seems to be the most overvalued ones. Now, there might be multiple reasons for Hudson Agro to be the best performing company. Might be the growth rate for this company would look very better, very good as compared to the other companies in the market. So we will be evaluating that part as well. Just let me delete this. Okay. Now everyone clear with the percentile part? The 100 percentile, the highest percentile and the lowest percentile. How is your value changing for 100 percentile? Okay, because the value for Hudson Agro is by mistakenly got deleted. Yes. The value over here was deleted by mistake. That's why. Then we will go with average is equals to average number one. We will select this whole range. We will have the average value. As we said, average is subject to outliers. We will focus our analysis on median. Median would be is equals to median now the 25th percentile is equals to percentile array. I will have to select 0.25 is 25th percentile, I guess. 49.0495. 75th percentile. This is the array, and 0.75. Comma 0.7. I'm sorry. 0.75. This is the 75th percentile. Now, I will simply drag this formula to the rest of the rows or columns, to the rest of the rows. I will get these value. Okay, all these values should also be in the multiple format. So I'm copying the format, Alt H, sorry, Alt S, T formats. Then these values are in percentage form. So I will copy this. We'll see Alt S, T. Now first we have set of price multiples, and then we have set of enterprise value multiples. Now the calculation for all these ratios would be somewhat different from the other one. These set of ratios, that is price multiple, will follow a different set of calculation as compared to enterprise value multiple. But guys, as we did study, if if I'm saying that we will be base our study on the median multiple, that is this one, and we also took some examples where we considered that if 62.53 is the multiple, let's say, then how will we come to the equity value? First of all, as you guys said, the formula for enterprise value, let me write that formula for you. Enterprise value is value of equity, value of equity, and that would be market value of equity plus market value of debt market value of equity plus market value of debt minus cash. Minus cash and short-term investments. Now, this is the formula for enterprise value. This is the formula for enterprise value. Now I want the formula for market value of equity. Can you rearrange this and give me the formula for market value of equity? Can you guys please rearrange this and give me the formula for market value of equity? Enterprise value minus market value of debt plus cash. Okay. So if I want to get market value of equity, I would want enterprise value less market value of debt less market value of debt, adding cash to it. This would be the formula for market value of equity. Fair enough. Now, Alt H. What value gives me the target price of the company? Whether market value of equity gives me the target price of the company, or whether the enterprise value gives me the target price of the company. The target price that we will determine based on our analysis will be given by market value of equity or the enterprise value. Guys, market value of equity, right? Now, how will I get the market value of equity based on this data? Price to earnings ratio is, let me write it down for you. Although we solved such an example in the last class as well, price to earnings ratio this time is 62.53. I want price and earnings that I have. Earnings is PAT 1849.05. Earnings is 1849.05. How can I determine the price of the company? How can I determine the price of the company? And the price that I will get over here would be what? It would be whether market value of equity or whether it would be enterprise value. Which among these two things would the price that we will be getting is going to be? It would be the market value of equity. Why? Because price to earning ratio was MPS, market price per share upon EPS. So that is market value of equity. Very good, guys. Very good. Moving on. Moving on. Tell me price of the company? What would be the price of the company? 1849.05. What would be the price of the company? 621. Okay. So the question is how we are going to determine the price of the company? The price of the company would be earnings into PE. So earnings gets cancelled and we are left with the price part. So to get that, let's calculate market value of equity is equals to this multiplied by earnings or PAT. This multiplied by PAT 115614 is what we have got. Is this my target price? Guys, is this my target price? Can the target price of something which is worth 625 be 115614? What adjustment do I need to make? What adjustment will I need to make? Correct, GA. Very good. Why always GA answers me first? Anyone else? I am not. Why did we take median? Because median is not subject to outliers. I'll write a note for you over here. Median is not subject to outliers, and because of same, we are basing. That's why we use median multiple. Fair enough. Correct. K and GA are correct. We have to make adjustment. We will come to that adjustment later. Meanwhile, those who were not able to answer this, yes, GA has some good previous experience. That's why, right, GA, you have some good experience related to accounting, right? So the notes, any idea for that, please? Because the backend team is working on it. The LMS is going through some maintenance issues. That's why it will be uploaded soon. It will be uploaded soon, AC. Okay, KA has experience in over-the-counter derivatives. Fair enough. Enterprise value. Okay. Market value of debt. Now, market value of debt over here is, we want market value of debt, market value of debt, market value of debt. This is my market value of debt. Cash, cash. This is my cash. Can I just drag this market value of debt to the future years as well? Can I take the same market value of debt for the future years and same market value of cash for the future multiples as well? Can I do that? Please let me know. Can I take the same cash value for the future multiples as well? Yes, I will have to take the same cash value for the future multiple as well, because the company is not getting changed. Neither it is cash value, neither it is debt value. So the value of debt and value of cash and short-term investments would be same for all the years. Moving on, based on this, how can we come to enterprise value? Based on this, how are we going to come to enterprise value? The formula for enterprise value would be market value of equity plus market value of debt minus cash and short-term investments. I am going to drag this formula, and this enterprise value does not rightly explains the enterprise value of other cells. Why? We will see that. Now we are done with market value of equity. We are done with market value of equities. Based on similar logic, how can we calculate market value of equity? Try yourself first. How will we be able to calculate market value of equity based on price to revenue? We had calculated market value of equity based on price to earnings ratio. Tell me, how can we calculate market value of equity based on price to revenue? Try yourself, guys, and let me know the answer. Try yourself first and let me know the answer. Okay. Market value of equity would be median multiple multiplied by, since revenue is in the denominator, we will be multiplying it with revenue. This would be the market value of equity. The format should be same across all the lines. So I'll keep the same format. Okay. Guys, did you got this figure? EV for price to revenue. Very good. GA is here with the EV for price to revenue. Let's check whether he is correct or not. Most of the times he is correct. Market value of equity plus debt minus cash. 118,055.6160. Perfect. Now, guys, are you able to comprehend the logic behind why we are multiplying these two terms, the median multiple and revenue? Please let me know if you are not getting this. Guys, please let me know if you are not getting this. I would be happy to explain it again because this is really important and highly testable. Guys, are you getting the logic behind why we are multiplying the median multiple with the revenue or earnings? Okay, I'll explain again. I knew based on the number of responses that I were getting. Remember in the last class, we saw, let me give you an example. Price to earnings ratio is, the median price to earnings ratio is 20. Earnings in this case is 10 times. Sorry, earning is not in times, 10 millions. Earning is 10. Let's say 10. The question is, what would be the price? What would be the price? Earnings are sale here. No, earnings is PAT. Profit after tax is earnings. Net income is earnings. Earnings are not sale, but net income. Net income is earnings. The price would be, based on simple algebra, earnings is 10. So I would substitute this with 10. This 10 will go over here. 20 into 10 gives me price as 200. And what is this price? This price is nothing but market value of equity or market price of equity. Market price. This price is nothing but market price. Okay. Based on the same logic, if price to book value is 21 and book value given to you is 12, what would be the price? What would be the price applying the same logic? Nikhil, please, you try. Nikhil, are you there in the class? 21 into 12, that is 12 into 21 gives me 252. So don't you think, guys, what we did over here to calculate the price? We did price to book value multiplied by book value, price to earnings multiplied by earnings. Now you will yourself tell me that if we are calculating price to revenue, what would be the formula to come up to the price? Can I say price to revenue would be, and if I want to get the price through price to revenue, it would be price to revenue multiplied by revenue. Can I say that? So for all the ratio, when numerator consists of price, can I just multiply the ratio with denominator and I will be left with price based on simple algebra, based on number of questions that we did in the last class as well on this? Guys, please do reply. Guys, do reply. Anyone who is still not clear with this? Anyone who is still not clear, those who asked me to explain me the reason why we are multiplying it over here. We are doing nothing. We are doing just the multiplication based on the simple algebra. This was based on price to revenue ratio. Therefore, price to revenue multiplied by revenue multiplied by revenue, that is sales. Okay. Price to earnings multiply to price to earnings over here. What we did, we multiplied price to earnings with earnings, that is PAT. Why we took median is because median is less subject to outliers. What I mean by that, when let's say this 17.55 is the value, let's say if I change this value, if there are operators driven in the market and they try to manipulate Larsen and Turbo Foods, they change the value to 999. They shoot up the multiple of this LT Foods to 999. So can you see my average has shooted up? My average has shooted up, almost doubled, or in the percentage terms, it has given an impact of more than 50%, or more than 100%. Sorry. So from 56, the average went to 121. Can you see from 56, the average went up to 121. But was there such a drastic change in median? The answer is no. The median showed us a small change. Median showed us a small change. Let's say if instead of 17.55, many of the people try shorting Larsen and Turbo Foods due to a short-term news related to Larsen and Turbo Food, and it has gone way below their historical level. Let's say the price to earning ratio for Larsen and Turbo Food has become 1. If I have changed this, see, mean has changed, but median is remaining same. Median has remained same. That is why we are using median, because median is less subject to outliers. That is what I am trying to explain from so long. Fair enough. Let's move on. Now you guys will tell me, since you have understood this, not only GA, but I want the reply from everyone else, including GA, that what would be the value for market value of equity for price to book value ratio in this case? What would be market value of equity? It would be 50th percentile multiplied by book value. Do I have book value available with me? Yes. And and enterprise value, market value of equity plus market value of debt minus cash. Very good. Very good DK. Very good GA. Now, now from here onwards, we are starting with enterprise value. From here onwards, what we are starting with is enterprise value. That is enterprise value to EBITDA, enterprise value to EBIT. Now, when we will be multiplying enterprise value to EBITDA with EBITDA, what we will be getting? When we will be multiplying enterprise value to EBITDA with EBITDA, what we will be getting? Whether we will be getting market value of equity or enterprise value. Guys, I am asking that when we will be multiplying enterprise value of EBITDA as usual, like we did with the denominator in the rest of the ratios, if EV by EBITDA is multiplied by EBITDA, we are left with EV. We are left with EV over here. Should I write the value that I will be getting over here, that is EV, in market value of equity over this cell, or should I write it in enterprise value in this cell? In which cell should I write it? In which cell should I implement the formula? In the EV cell or market value of equity cell? Guys, please reply. Please do reply if you have understood it, and please let me know if you want me to explain this again. Shall I implement this formula in EV cell or market value of equity cell? Okay, MM is saying market value of equity. Anyone else who is saying market value of equity, please do reply. Who else feels except MM? I have received responses about EV. It's fair enough. But anyone else who feels that whether it is about market value of equity? Okay. Now, MM, I'm talking to you. Manasvi, please pay attention and please do reply when I'll ask you. Sure, I am repeating. I am repeating for MM and Asha. EV by EBITDA. This is one of the ratio. This is the multiple EV by EBITDA. When I will multiply EV by EBITDA with EBITDA, what I am left with? What I am left with? When I will multiply EV by EBITDA cancels off. What I am left with? EV. So, would it be appropriate for me to mention the value of EV in market value of equity? Don't you think if the value that I'm getting is EV, it should be mentioned in the column for EV itself or in the row for EV itself? It should not be mentioned in the row for market value of equity. That would be wrong. It should be implemented in EV itself. Are you getting this? Nikhil, have you got this? Nikhil, perfect. Nikhil, did you join late today? Okay. I, okay, no worries. I will have to laser select. So BK, even if you joined late as well, you will have to go through the recordings in case you feel that you're not able to get it. We can connect for a session on weekdays between Monday to Friday. in Saturday, Sundays, it's not really possible to conduct doubt solving sessions because we have live classes on Saturdays and Sundays. Also, mock interviews are also going on. So the schedules on Monday to Wednesday are open. You can raise a ticket on those days to get the prompt responses. Market value of equity. This time we will be having our EV by EBITDA into EBITDA. Do I have my EBITDA with me? Yes. Now, what would be the value? What would be the value for my enterprise value minus debt plus cash will give me my equity value. Enterprise value minus debt plus cash will give me my equity value. Next, next. What is the next set of ratios? EV by EBIT. What should I do over here? What would be the formula for EV by EBIT? Is equals to enterprise value into EBIT multiply by EBIT. Enterprise value into EBIT multiplied by EBIT. Am I correct over here, guys? Guys, am I correct over here? Shall I proceed with enterprise value as market value of equity plus debt minus cash? Shall I do this? Anyone? Yes, GA, I know. Anyone else? I am just trying to check that how many of you are attentive. What mistake have I made over here? What mistake have I made over here? Guys, those who are attentive, please do reply. I am myself saying that I have made a mistake. What mistake have I made over here? Correct, Asha, you are correct. Yes, Asha, you are correct. I accept my mistake. But waiting for more responses. What mistake did I make over here? I used enterprise value multiple in market value while calculating market value of equity. And that is what I am wrong about. So I will be using EV to EBIT multiplied by EBIT. EV to EBIT multiplied by EBIT is equals to enterprise value minus debt plus cash. This is the value I am available with. Next, the next set of ratio is enterprise value to revenue. Enterprise value to revenue is equals to enterprise value to revenue multiplied by sales, that is revenue. The value that I'll be getting is mark plus cash. Fair enough. Next we have enterprise value with respect to PE growth. Very important. PE growth. Now, can anyone try first yourself and get the market value of equity? I think I'm pretty much sure that if price earnings to growth rate, the ratio is 6.34. This is the ratio. Can any one of you, please, I would be very much happy if any one of you try to apply this ratio to get the market value of equity. Can any one of you try this? Please. I would be very much happy. If any one of you gets the value for market value of equity, come on, guys, make me happy. Based on price earnings to growth rate, the growth rate that we want, I would also give you that it's 9.05. So growth rate is 9.05. Based on this, please do try to get the value or market value of equity. Okay, K, agreed. So K is there with a reply. Not the right answer, not the full answer, but she is one step ahead in a process at least. Very good. So I have not verified it yet, but GA says 106191.62. This is the value, this is the market value of equity, what GA has got. Waiting for more replies so I can list down all of your names as well. Guys, do you want time? Very good, Chetan. Very good. Very good, Chetan. Okay. AP is saying, Chetan, please reply with your value as well. So I can write down your name as well. 110342. Third. Okay. How many of you want more time to try this? Please let me know. If you are giving up, also do let me know so that I can move ahead. Growth rate is 9.86. Yes. Growth rate is 9.05. 9.05 is the growth rate. Okay. Okay. What will happen? Price earnings to growth. What will happen when I will multiply this with growth rate? What is the value that I will be left with? Okay. Okay. So K is asking me to wait. Let me wait. Some other people are trying as well. 10168.927. 168.927. Only three people in the class. Nikhil, guys, please give your response. Yes, Chetan did reply with the formula, but not with the value. Okay, I'll consider that as well. Okay, Chetan also came up with the value 106205.6. Everyone getting some other value. Let's check. Let's check. Shall we start with the explanation part? Okay. Price earnings. Okay, Shatrughan says 106292.06. 106292 106092.06. Okay. 106092.06. Fair enough. Price earnings to growth. What happens when I multiply this with growth rate? Okay, writing the final name, Nikhil 10691.03. So guys, window is closed. Let's now get to the explanation part. Price earnings to growth rate multiplied with growth rate. What are we left with? Price earnings to growth rate multiplied with growth rate. Can I say I'm left with PE? PE multiplied with earnings. What I will be left with? Price. And don't you think this is what the price that we wanted? Market value, basically intrinsic value in our case. So the formula will be price earnings to growth multiplied by growth multiplied by earnings. Don't you think so, guys? That would give us our price. Let's try to implement it and let's check for the answer. Multiply by growth multiply by earnings, that is PAT 106,205.60. 106,205.60. Okay, moving ahead, finally dividend yield. Try to solve for market price of equity or enterprise value. If the formula for dividend yield is DPS, dividend per share upon market price per share, or dividend upon market cap. Try to solve for price. If the formula for dividend yield is this one, try to solve for market value of equity. Give me the answers so that I can write out the names. Guys, the right answer or the wrong answer is not important. The important thing is you should try. Only then you will be able to realize that where are we being wrong. DPS 97, 974.6. No. Okay. So it's not dividend per share, but dividend. Okay. Dividend value. It's not dividend per share, but dividend value. Give me the equity value K. Okay. Chetan is here with the market value of equity. 144,421.79, 11122.6865. 49185. Okay. AP says 106831.12. Okay. Anyone else who is trying? Nikhil, 1443.68. So are you here with the target price directly with intrinsic value? Let's try. First of all, formula was dividend yield. Formula for dividend yield was, okay. Final response. I'm taking the final response with Shatrughan. 11122.2068. Okay, the window is closed now. DPS upon market price or price. We have dividend with us. So the price would be DPS multiplied by dividend yield. Now, DPS or dividend, since we are calculating for the overall company, it would be dividend upon divided by dividend yield 0.67. It's 14441. 14421. Okay. GA, where were you wrong about this? Okay. Is equals to enterprise value is equals to market value of equity plus debt minus cash. Okay. Are we done with our part? Have we got what we wanted? Shall we just close this file and move on to the next module, or are we left with something? Yes, I will be repeating. Just give me a second. Just give me one single second. Oh shit. Just give me a second. The laptop or the Excel part. Okay. Just give me a second. Just give me a second. I just hope that the file should. Okay. Now, while working on Excel, if Excel gets hanged in between, the concern always arises that whether is my file safe or not. Okay, fair enough. Yes, I will repeat. Formula for dividend yield is we can put auto saver for 1 minute. Yes, but sometimes, okay, yes. And also while making a model like DCF model, it's important that you say if you are done with three financial statement, you create a copy and make work on a different model. Now, where was I? Yes, dividend yield. Dividend yield is equals to dividend upon market cap or market value of equity. Market cap is nothing but market value of equity. Now, we have our dividend yield available with us, that is 0.67%. We had our dividend available with us, that is 974.6. GA, were you able to spot your mistake? 974.6. Equity 974.6 about divided by 0.67% gives you the market value of equity. Basically, what we did, we bought the dividend yield part over here and divided it. We bought market cap part over here and and made it to the numerator. K, this time have you got this? Okay, we will be coming to the MPS as well. K, have you got this time? Are you able to get this K? Please let me know so that I can move forward or repeat it again. Finally, K, please reply. Formula is dividend divided by dividend yield, median dividend yield. Dividend divided by median dividend yield. This is what we did. Fair enough. Let's start. Target price or intrinsic value. Target price or intrinsic value. For that, we will be needing our number of shares. Data sheet, number of shares, number of equity shares 177.3. We will keep it same because number of share will be same for all the ratios is equals to this divided by this 652 to 814 price to book value not being the appropriate benchmark since giving us an outlier, we will be getting the target price of the company based on average. Now you would say why I am taking average this time. I'll let you know because we will already be ignoring outliers. The average target price for the company is 675.66. The current market price is 627.55. So based on the relative valuation approach and fundamentals of the company, that is Dabur, you can expect expected returns. This divided by this minus 1 voltage P, you can expect return of around 7.67% in Dabur India. Why we are taking average sometime? Not sometime, but only this time we are taking average because we spotted this as an outlier and we took average over here. Now the challenge is we why we are not taking median over here. Anyone try to justify this? Can anyone try to justify this? These are my values. These are my values, and I am not interested in taking median over here. Why? Arrange these values in the chronological order. These are the values that we have got. I'm already ignoring the outlier part, 190, and I am making my judgment based on these values. Yes, outlier is removed. That is one of the reason that now why would I be taking mean value and not the median value this time? Why would I be doing it? So median only represents the middle value. If let's say this is my median is equals to median, this is my median value. This is my median value, and my mean would be is equals to average. This is my mean. Now let's say if I change any of these values, 599 to 400, that change in impact of the overall industry will be reflected in my mean, but that change won't be reflected in my median. Are you able to see it? That change would be reflected in my mean, but that change I won't be able to see in my median. That is why I am interested in taking the mean value and not the median value, because I want to incorporate the trend in future if based on dividend yield. Let's suppose this company Dabur India gives a huge dividend, and based on dividend yield, it is value at 1,500 or 1,500. So I want this value to impact the value of my target price. That is why I am taking mean over here. Otherwise, if I would have taken median instead of 814, if this would have become 1,500, my mean would have changed, but my median would have not been changed. That is why median is not the accurate metric to be used over here in this case. Everyone there with me? GA, have you understood this? Perfect. Recommendation is equals to, if this is greater than current market price, value if true, buy, value if false, sell. We can consider price to book also in target price. Yes, we can consider that, but the reason why I am not considering it is the deflection in target in book to value ratio, price to book value ratio is very high, and based on that, we are getting something which is impossible to be incorporated. So not impossible to be very honest, but which is very indifferent from the average range of the values. Okay, that is why I will be ignoring price. Also, one thing that you need to understand that probably dividend yield also might not be the best metric to be analyzed. So what I'm trying to say over here is you need to evaluate with your consideration that which value is suitable for the company. If this is not a dividend paying stock, if the overall industry is not a dividend paying one, then you can avoid the dividend yield as well. The reason why I need to incorporate all these ratios is what I wanted to make you know that how can you calculate the respective target price based on all these ratios. Okay. And let's check what is the price if we incorporate the price is somewhat different. Okay. So it's also to the analyst choice. If you want to include price to book value, you can include that. But since there is so much of deflection in price to book value, I'm not considering to include it while doing the calculation of my target price. Recommendation based on buy, I will do the conditional formatting, highlight cell rules equal to buy in a green color. Okay. And if it is sell, the value should be in red color. Okay. Now, now with this, okay, let's try this as well. Additional formatting, highlight cell rules equal to lowest conditional formatting, highlight cell rules. Okay, no. I'm really sorry. The lowest would be the in green color and the highest would be in red color because how you find expected return? We found expected return by using the formula target price divided by current market price minus one. Target price divided by current market price minus. Okay. Now, conditional formatting, highlight cell rules, peer rules from selected cells. Okay. Conditional formatting, highlight cell rules equal to what? Equal to the lowest value would be in green color because that is undervalue. The highest value equal to would be in red color. The highest value is this, that would be in red color. Okay. Based on this, you can implement the same format. So see, while pasting the format, does that also get conditional format also gets pasted? GA while pasting the format, does conditional formatting part also gets pasted? Any idea about it? If not, we will be have to implement it again. So based on this, you can implement in each and every cell. I will implement it after the class and share this sheet to get it uploaded on the LMS. Meanwhile, I will also be Just give me a second. Now, some things you will have to take care of yourself. Now, this is merger. This was merged and centered. Now, my model is made till here, so you will have to merge and center it over here and clear all these lines. Alt H. This will be your model, Dabur India. You can also work on some of the formatting part. The next part is going to be very much exciting, very exciting. That is the startup valuation part. We are going to consider a case study. Okay. Just add borders to it. Perfect. Okay. So yeah, I am not talking anything. That's why the voice might not be clearly audible. I am just trying to fix some formatting part. Okay, done. Adding disclaimer to the bottom. Make sure, guys, that you implement this conditional formatting to the other cells as well. Okay. Done with this, saved, sharing the sheet with you. Okay. Now, shall we start with the startup valuation part, or shall we keep the startup valuation part for the next class? Now, the interesting part is what is going to happen from here onwards is there are two models associated to startup valuation. One model we are going to make in class together. The other model that we will be doing is, yes, let me complete, please, Asha. So the other model that we will be doing is, I will be giving you a problem statement and you will have to make a model of your own. You will have to make that model on your own in the live class itself. In the live class itself. So I I will be sharing you the problem statement, and after sharing you the problem statement, I will be starting with making the model. 15 to 20 minutes after I have shared the problem statement with you, I want you to move forward while trying on your own. And if you are stuck anywhere, you can see the screen and you can check for the reference purpose. Okay. For expected return, what should be in denominator? The current market price should be in denominator. Okay. Then let me share the sheet with you. Is the sheet available to you? The cab service model? Is the sheet available to you guys? In the chat box, please do see. Okay. We will be not starting with the modeling part. Yeah, I know. We didn't take a break as well. So don't worry, Batlan sir. We will take the break. So guys, can we come to a consensus? Shall we start today or shall we wait for the next class? Shall we start on the next class? So if you don't want to forget, you will have to keep practicing it. That is the only solution in it. Not show slide, next class, next class, next class, please. Today, GA says today. So let me digest today's first. Start at next class. Okay, okay. We will be not starting it. We will be not starting it, but just make sure you go through the model, you read through the model, see the assumptions. Let me know if any of these assumptions are unrealistic ones. The assumptions that we have taken over here. If you want, you can add any of the assumptions of your own as well. Like, like what? Like name of the car or car model that you want to work on for the cab service business that we will be evaluating. Based on that, this this topic in finance refers to corporate finance. So when you will working with a MNC company as a CEO, CFO, or the top tier management, you will be associated in evaluating where you should take the particular project or not. Why? Because resources are limited, not only for you, not only for me, but for biggest of biggest firms, the resources are limited, the capital is limited, and it is appropriate, it is it is expected to put your capital to the right choice, invest your capital or park your capital at the right place. So whether you should invest in this model or not is what you are expected to conclude out of this model. So let me save this model. Sure, Ines. Sure. Just mention the timing on the portal as well. Okay. So that was it. If you guys have any doubt, please let me know. Otherwise, we can call it off for the day. Thank you, guys. Thank you. Thanks a lot. Thank you, guys. Bye bye. Take care. Have fun. Enjoy the rest of the evening. Bye. Bye bye. Have fun. Thank you, guys. Thank you, GA. Thank you, PK. Bye bye. KK. Bye. Asha Shatrughan. Bye bye. Bye bye, AP. Bye, NS. Bye, SK. So let's call it the day. Thanks. So no credits to me about the class timings, Asha, but I'm glad that someone So it's not possible to please everyone, right? Everyone would be comfortable with some one single time. So for few days, the guys who are not comfortable from 9:30 to 11:30 manage for few days. You guys, those who are working professional, you guys try to manage. Okay, Ne. Glad to have you here. So AM, the sheet is being shared on the chat box. Also, the sheet will be uploaded on LMS today itself. So bye bye guys. Take care. Have fun. See you guys tomorrow.